there has likely to be a wider set of applications that are possible and that have good traction on chain, and ecosystems are likely to be better at that. I would definitely agree with that, but that requires exploration, and exploration takes time. It not only takes time, exploration until you find something that works, and then develop the traction and the narrative and whatnot. That could easily take you a cycle.
Well, one way to maybe like frame this, and I don't know if this is correct, but I mean, it would be pretty damning for ecosystems if it was. And I think this in some ways tracks what we've seen so far. But maybe like ecosystems are just where like innovation tends to happen because it's faster to get off the ground. You have an existing user base you can tap into, you have some existing liquidity, etc. And then when things like when specific categories are identified, then you like the optimal version of that is actually never built on top of a platform, but is rather something very like use case specific. And so maybe that's sort of the life cycle.
I like that.
Which is pretty damning for ecosystems in so many ways, because like it means that they need to constantly reinvent themselves and they never win the final race in a sense. Here we go again. Much sooner than we've been on a good cadence.
Yeah, actually. I mean, even if we are releasing the things kind of like just as whatever we predicted happened, unfortunately, but we need to get faster at the editing, I guess.
I mean, this last episode was, I think, good. It's just probably confusing for listeners because we obviously talked about DeFi hacks and the use of AI and all this other stuff in hacking. And then the Aave helped out stuff happened. And then we released that with a topic that sounded like it was about it, but it wasn't.
Yeah. And for today's April 23rd, we'll see when this ends up being released.
Yeah.
I recommend that we do in big capital letters, emergency podcast kind of thing, but we release it always one emergency too late. So you're the previous when you're expecting.
This is the way to really like gain the trust of your audience, huh? Every time they click, it's just they think it's very topical and relevant, and it's not. Anyways, we're probably going to discuss the most recent hacks and stuff at the end, but first we have a new section, which is Mika's financial advice section. We were just discussing, we're not sure if we should, like, if there's any genuine risk in specifically naming a section like that, but obviously nothing is actually financial advice. We have no idea what we're doing.
No, he is not an actual professor of Ponzinomics. He just plays one on the podcast.
Yeah.
I'll say Ricardo started this before we turned on the recording about Sol looking weak relative to like BTC looks the best, or of the top three assets here, BTC looks the best, then ETH is second best, and Sol is lagging behind. So like the Sol ETH ratio is the worst. So yeah, kind of my framework for this is, if you take the kind of crypto cyclical view and just play it by that, with some of like the kind of modern dynamics coming in, I do think like there was the previous cycle where ETH was horrible and Sol was awesome. And you had like the previous cycle before that where you had a bit of a disappointing BTC cycle and a great ETH cycle and so forth. So I think from there, my natural instinct here is, in terms of financial advice and not financial advice, is that like hype looks strongest for this cycle. And if you kind of take the cyclical winner with kind of a healthy ownership base in a way, and kind of the supply demand dynamics being in their favor, plus the actual kind of revenue story being behind them as well, that makes me think that they're going to outperform, and they already have kind of early on in this kind of, as we've bottomed out, they've been the best.
So just to sort of like repeat that back to you, what you're saying is like when there's kind of like a new project on the block, it eats kind of like some of the the new incumbents lunch. So Sol was
and
Sol was kind of like the challenger for Ethereum, and now Hype is kind of challenger for Sol. That's sort of the
Yeah, and Hype is like genuinely the big winner at the moment in perps, and Sol doesn't compete that well in perps. And even if Sol does, it's a Sol project. Hype has the specific advantage of that money actually going to Hype token holders. I think there is like a sort of supply demand story as well, always being told here, which is like Hype doesn't really have actually this part of the first part of it, but which is like that there was horrible supply overhang on ETH back in the day with ICOs. There was horrible supply overhang with FTX and Solana. And that kind of allows you to create like a really insane bottom and allows you to get that like 30x, which Sol got in the last cycle. So I think like Hype maybe doesn't have the kind of first part of that, but it does have the second part of that, which is like when that when like it has a pretty clean cap table in a sense, where the team could be selling, but like the team actually has been pretty like not just like dumping these positions on people and have kind of like done that. Like they're making a lot of money annually right now. There's going to be like, if any extra kind of trading volume comes into crypto, there's going to be like multi-billion buy pressure on that thing naturally, in addition to the fact that no funds actually owned it from day one. So some funds bought in obviously on the kind of top and aren't up, but there are probably like some funds who are able to also buy here for the first time essentially and buy it as like kind of a clear position for them for the next cycle. So those supply demand dynamics work kind of well for them. And perhaps it means something that ever before for any other project.
Do you know what the kind of like unlock schedule looks like?
Yeah, the team has linear unlocks from here, but I think they made it, I would have to check this, but they made it smaller as well for them or something like that, where the amount isn't so large. Like the amount relative to what's naturally burned, I think is like pretty healthy already, where like the holders revenue, the burn is already at like 700 mil a year at the current pace if you take the last month. And like crypto perps that could easily be 4 or 5 bill, like for this project. So it's the supply demand is going to be really nice.
So why do you guys think Hype has done so well?
Okay. So Mika, thanks for defining the healthy ownership thing, because I think it's a concept that most people don't necessarily end up grasping. Look, I don't think I'm going to say anything we haven't said before on the pod. For what it's worth, I did not say that Sol looked the weakest. I said Sol looked like shit, because actually it does. And if you look at versus Hype, you look like at the Sol Hype, it looks even fucking worse than all the rest. Now, about for what Hype has done so well generally and versus Sol, leaving aside the ownership thing, we have discussed that basically the key thing that like where crypto has product market fit so far is finance. And a lot of what captures people's attention is basically trading on perps. So Hyperliquid is tackling the area where crypto has had has had the most product market fit. Why? When you rephrase what Mika had said, Teemu, you said that, the new entrant is going to eat the incumbent's lunch. I don't think it's just that. I think it's not just that Hype is new, because if that were the case, you could argue that Sui or Aptos or any of those should be eating Sol's lunch. It is basically that they're executing very well in a very particular vertical. And it is also the vertical that benefited the most from Solana's value proposition, which was cheap, high-frequency transactions, effectively. So this stole most of Solana's launch ended up leaving it as a, sadly, by and large, chain for, trading meme coins and that kind of stuff, which was the other high-frequency thing that was happening on Solana. And now on top of that, we have had quite a few events and sold in the past 3 months of treasuries or projects being drained, which, if anybody's paying attention, should basically be casting a lot of doubt on the effectively the professionalism of the teams operating on the chain. Right, a chain is, in the end of the day, an ecosystem. That's what's going to end up bringing most of the value. If you're not going to have an ecosystem, you might as well be like Hyperliquid, where you have an extremely good product that does one thing well. And right now, it is unclear to me how long it is going to take the Solana ecosystem to develop from the impact that the teams, that trust in the teams has taken doing this.
To me, this is also a story of, like, there's some story of like vertical integration, and Perps is the crypto app that makes a lot of money. So like Spot Solana has a lot of volume, and Spot Solana does really well for the assets which are on the chain, and some bridged assets as well. But particularly, like, there's nothing like having success in Perps. Hype is actually one of the best examples of, like, the amount of traders on Hyperliquid isn't that large by kind of some metrics that you would look at, and probably a lot smaller than the centralized exchanges. But the volumes are quite good, and I think that's because a lot of the crypto native volume actually is there, like quite a big chunk of it, and I think, like, kind of, well, yes, large, like, or the kind of larger firms are there, but also like the kind of prosumer, I think, are quite well there. And I think a lot of those prosumers are also holders of Hype. So they're just like, the exchange is good enough. Like, I think the exchange is actually slightly worse than like kind of the centralized exchanges in many ways, but the exchange is good enough where it gets the job done. And then I feel like there is this alignment where, hey, like, it's actually good to trade on Hype. And like that group will trade on Hype because, like, you own it, why not? You get a good service, so it kind of, the alignment between users and the exchange works well there. I think they do have a question of, does the pie really grow? Do they kind of grow the user base actually to a more broad set of users? And I don't see, that's maybe the weakness where I'm not sure if the exchange, based on its like current level of tooling and just how it feels, is quite there.
Well, the other kind of related question is, like, how big can you get on Perps alone? And this sort of like ties into another question, which is like, how many other categories are there that matter? If there are a lot of categories that matter, then you would assume that the ecosystems would like eventually kind of do better, especially if they're high performance like Solana. If there's 2-3 categories that matter, then of course, like, that puts something like Hyperliquid in a very good position. But somehow my intuition is that it can't be the case that, like, it's all just Perps. But one thing that, just before I get your response, is like, one thing that I think is clear from past history is that even though there are quite a lot of sectors that matter, they seem to matter at different times. So at any one time, we really only have like 2 things that like blow up. You can look at, kind of spot DAX lending markets in DeFi summer. You can look at stable coins. You can look at perps and prediction markets now. I mean, maybe there's like, you could maybe add another one in there, but so like temporally at any one time, there's like not that many things. But then over time, I guess I'm kind of arguing myself out of this a little bit, but like over time, if there's more of these categories that end up mattering, even if it's at different times, that does create a chance for the ecosystems to kind of constantly reinvent themselves, while things like Hype would be kind of like overtaken by new focused and specialized projects for something that's becoming relevant. But it could also be that, like, we've already discovered most of the things. Like, I don't know.
Maybe one framework to think about it is also like using the same thing we talked about before in episodes about how incumbents have been given time to understand like kind of what the use cases are and like to take them for themselves. I think there is an element, some sort of element of that in the sense that this is like an L1 that's vertically integrated to hold the perps, and perps gets you a couple of different things from that. It gets you spot very easily as well, and then it gets you lending as well quite easily on top.
Yeah.
So as products, those products are synergistic. So and then of course prediction markets as well is kind of an extension of spot slash whatever binary options.
Yeah.
But like so like they are, when these categories are so you're right that when these categories are so dominant, like I think this kind of approach works really, really nicely. And then like it could be kind of a, in some sense, a next cycle thing where if crypto really kind of wins big across kind of the legacy institutional TradFi stack, and in terms of like kind of a more internet native approach, that then the explosion again kind of happens where it feels like there's a lot more opportunity whether or not those really work out. But like now when we have the few things that have product market fit, it makes most sense to scale them, and for that like foreseeable future, that makes Hype kind of very strong to me.
Yeah, that's one point that I wanted to make. It's not that it's all perps, Teemu. But perps is the high frequency one, and the high frequency one is the one that gets you the fees as a base chain or as an application. And in fact, there are those three categories that are very tightly coupled that Mika or that can be very tightly coupled that Mika mentioned. If you have perps, chances are that you want lending because people are going to want leverage, and actually drifted very well at those two while it managed to operate and before Jupiter perps showed up. And then there's swaps, because you're not necessarily going to want to, if you're liquidating, you don't necessarily want to get the collateral that you want, that you keep. Back then, Drift wasn't that good at that, but it was tightly integrated with Jupiter for it. So with those three things, you have basically covered most of the financial activity that is happening on chain, or then, RWAs and maybe people spawning their own tokens kind of thing. And while I would agree with what you said, that it can't just be, perhaps it can't just be these three things, and that if we do get a wider, there has likely to be a wider set of applications that are possible and that have good traction on chain, and ecosystems are likely to be better at that. I would definitely agree with that. But that requires exploration, and exploration takes time. Not only takes time, exploration until you find something that works, and then develop the traction and the narrative and whatnot, that could easily take you a cycle.
Well, one way to maybe like frame this, and I don't know if this is correct, but I mean, it would be pretty damning for ecosystems if it was. And I think this in some ways tracks what we've seen so far. But maybe like ecosystems are just where like innovation tends to happen, because it's faster to get off the ground. You have an existing user base you can tap into, you have some existing liquidity, etc. And then when specific categories are identified, then you like the optimal version of that is actually never built on top of a platform, but is rather something very like use case specific. And so maybe that's sort of the life cycle.
I like that.
Which is pretty damning for ecosystems in so many ways, because like it means that they need to constantly reinvent themselves, and they never win the final race in a sense.
Okay, and that is related to a kind of like I guess a discussion hand grenade that I was about to throw out. Well, okay, I'm gonna finger quote decentralized and hype, right? Because they have in theory somebody else.
I mean, you better.
Yeah, this is a centralized thing, but do we think that the fact that basically there is a dichotomy where exploration is better on a censorship resistant platform like Solana, but actual value extraction is better on a more centralized platform that enables censorship, so that you can control for general market fuckiness, like what you suggested, L2s might start censoring transactions in the future?
Partially. I'll also say that I think this is somewhat path dependent, where Solana could have a healthier perp ecosystem and could have and things could have gone in a way, I think, historically, where they would be in a stronger looking positioned to succeed or specific project on Solana. So I don't think it's like fully there. I think it was also like, you know, if some aspects of Solana had been designed differently and it had been a little further along in its roadmap a couple of years ago, like I think things could have been different as well. I don't think it's just
Well, like what? Can you give me an example of something that you think would have made a significant difference?
every single like drop in milliseconds to like transaction execution, yeah, it kind of helps.
Okay, so congestion issues that we saw a couple of years ago.
Well, congestion is different. I assume congestion would have been fixed as well. Like you have to fix that as well. But yeah, I still think in those cases, like it's true that Solana wouldn't necessarily capture the value, but the stack would look a little bit different, where it would feel like Solana is this kind of healthy, like partner to an exchange, and that exchange right now, Solana is the biggest thing on Solana in a way. Ethereum is the biggest thing on Ethereum. That's kind of a weird setup, right? So like, but yeah, it's still true that like, you know, yeah, what you said.
So what, like, I think you were referencing something that I commented regarding like L2 sequencers could censor transactions, and I think will to prevent malicious behavior. So as a little bit of a segue, I've actually been thinking about that, and Ethereum people are going to hate this, but so on Ethereum, I think it's like 90% of blocks or something are built by, I don't know, like 2 block builders, something like that. I would imagine that if you take like 4 block builders, it's about 100%. So given that, I actually think that this is not only something that a centralized sequencer can do, but in principle could be done on Ethereum through the block builders, where the block builders could essentially scan for malicious transactions as they build their like MEV optimized blocks and censor them. And now obviously Ethereum is taking Ethereum is instituting this new thing where like if a transaction hasn't been included in a block, and I think it was like 4 blocks or something like that, then it has to be included in the next block, like a protocol level rule. So that kind of like kills this idea to an extent. You could only delay, but in principle,
all right, just like can't you just be like, hey, I never saw that thing? Like what? Like how do you?
I mean, you can just get punished. It's been sitting in the mempool for a while.
Yeah. So there's like
the mempool is fast.
everyone else, which is like, yeah, we saw that thing. You should have seen it as well.
Okay, but that doesn't work if blocks are full or the transaction doesn't fit a block. So there has to be some transactions that are still going to get dropped anyway, right?
Yeah, I assume this is fee dependent. Like if it was like pay the appropriate fee to get in within and blocks.
But even if it paid the appropriate fee, I should be allowed to pick what goes on the block. If the block is full, why are you going to penalize me for not picking a transaction that just because it's sold?
I don't know the specific implementation details, but like regardless, in principle, I agree. There's edge cases, there's designs that could be
Looks really
those edge cases, but the point is they're specifically doing this to prevent this sort of like censorship that has been happening. I would imagine over like OFAC transactions and things like that. But in principle, like, look, Ethereum is going to go the way it's going to go. But in principle, a blockchain where the blocks are being built by a relatively like small amount of parties, like where there's an auction mechanism and whatever, like they could be scanning the mempool for malicious transactions and blocking those. Like that is possible, even while retaining the sort of decentralized nature of it, given that like if all these like honest block builders are blocking malicious transactions, then in order for a malicious party to get their malicious transaction through, they would need to essentially like bid for building that block, and have enough of a distribution of validators and whatever that like they're able to get it in. And so it at least makes it like considerably more difficult even in the Ethereum case. And I suspect like simply having mechanisms to delay them would be easy. Like, I don't know how difficult it is actually to like understand whether a transaction is malicious, but I'm sure there's at least like a large segment of them which are very obvious.
I don't know. I was going to ask that actually, because how do you determine? I can imagine that some things like, oh, I've seen the signature before, for instance, and so that's obviously a smart contract bug that is accepting reused signatures, yada yada. That's an obvious malicious transaction. But something like the drift exploit is, I think, would have been pretty much indistinguishable from an illiquid token price manipulation. And those things, like, are you going to say that it's malicious, or are you just going to say like this token happens to be illiquid right now?
Yeah, I'll just say that there is also like no situation in the history of finance where the borrow limits against new assets or fringe assets ever needs to be changed by 3 orders of magnitude within one transaction. Like all these look very, very like to a human, like there's no not a single time anyone has pulled from Aave more than X million dollars, you know, and
but you do realize that this is not something you can likely evaluate on Solana if it is a closed contract. It's a closed source contract that just some values in a table somewhere got modified. You have to, for you to realize that this is a malicious contract, you have to know exactly what the contract is doing. For that, you need to have seen the contract, right? Otherwise, you don't know what these 3 parameters are doing upon execution. You know that somebody changed those in late.
I don't think you can stop hacks. I think the most realistic kind of thing to do here is to make them an acceptable amount of TVL when they do happen. And I think that should have been on the table for Drift. It should have been on the table for Aave in this specific case where the loss is small. Like that is actually realistic.
I agree, but what my point is, this is something that smart contract with the application writers can know and hopefully try to detect. But once a change has been deployed, particularly for a project that got deployed from a closed source compiled thing somewhere on the Solana chain, a validator doesn't necessarily know what changing these 3 values somewhere is doing. So a validator cannot know that that is necessarily a malicious update that's going to have an impact in 3 days, right?
Yeah, you're right.
Yeah, I mean, look, I'm not saying that, like, if someone's private key gets compromised, like, there's nothing a validator can do to understand that that's what's happened. I'm just saying there's probably categories of attacks which can actually be at least slowed down. And so, like, one way to sort of think about an implementation would be as in terms of a risk matrix, where, like, instead of like blocking things, you delay things, you give more time to the teams to react, etc. And the only people that can really do that are the validators. Of course, the protocol operator should also have like time delays and things like that in their protocol. But I don't know. It might be that it's not practical for some reasons, but I do think there's like probably stuff that can be done there that like helps for a certain category. Regardless, this most recent Aave thing, my quick take is that everybody in this process fucked up. It was not a single party that fucked up, but rather everyone fucked up. Kelp DAO had a 1 out of 1 signer. Layer 0 signer or whatever got compromised, and then Aave let a 1/1 backed asset into collateral. And so like literally everyone in the chain fucked up.
Yeah, and
And
in
then
like
exactly.
quite equal amounts, I would say, where this feels everyone is to blame very equally here, which is kind of interesting as well.
Yeah, I'm not sure how
Everyone's
it would
also-
distribute, but everyone else. I mean, everybody's finger pointing, yeah, but I do agree that everybody on the whole chain fucked up in the same way that on the Drift situation. Basically, the only ones that I wouldn't blame are the validators. Drift fucked up, Circle fucked up.
We do get some like so I think everyone has heard of the hack and whatever. Like I think probably we all agree that Aave is going to survive. And even though Aave did kind of fuck up, it wasn't so much that their like protocol was compromised. It was more that their like risk management wasn't quite what you would want it to be.
Well, but I would argue that, and I know this wasn't what cost it because they had an exited, but it was about a week or two before that the risk management firm said that they were moving on because Aave was lowballing them. So this is definitely something that looks bad for Aave. Again, it's just an issue of perception. It's an issue of, it gives the impression of Aave doesn't really give a shit about security because they are lowballing a security firm that very rightfully had argued that they could not adequately cover V3 and V4's significantly increased surface with what they were offering, right? So I would say that even though they were in compromise, this does point to the fact that they may be subject to economic attacks just because they're being fucking cheap.
Yeah, but I will the counter argument to that is this happened on the previous watch. Like this like like with
I agree.
you could even be like, hey, like these guys deserve to be fired at this point. Like so it depends.
So, I don't know, man. I kind of agree, but the fact that you have to argue with a penny pinching employer when you're providing security, and when another security firm just walk, right? This does point to a certain mentality within Aave.
Yeah, but if they don't walk, this hack still happens. So it's like,
sure. What I'm saying, that's why I precisely said that this had happened before.
Just more importantly,
badly.
I mean, the other framing for this, right, is like maybe they had to walk because they knew there was a lot of sketchy shit.
Yeah.
But I agree with Mika in the sense that like this was on their watch. Like this doesn't exonerate them. It's not like they got out just in time. It was like,
no.
It's really bad.
I did check the collateral list after this, and this was the like if you look at it, just even trying to like take the hindsight bias out of it, this seemed like the most risky one. Like you take the other ones and you go look at the kind of the way they're set up, their layer 0, yada yada, looks a lot more normal. At least there has to be kind of, but it is true still that like Aave as a bank is undercapitalized for the assets that they manage on their balance sheet. And yes, the other attacks are more complicated. However, each of those attacks is borderline, especially these like kind of LST looping plays. Each of those is in like this isn't existential, but like essential. Like this is like in the ballpark of like this is the limit of what you can take for sure, right? So or somewhat close to the limit in terms of like one order of magnitude up, and then we have a real problem on our hands, right? So like each of there is still like that chance, and I'll say like this isn't like how bank collateral works and the regulations around that is actually like kind of a bit better than this in some sense. Like if one of these things gets hacked in the future, where the attack it obviously has to be more complex and stuff, but like it's not great.
Well, I mean, bank collateral doesn't function under the assumption that some of it just disappears every now and then. Like,
yeah. There's different risks.
It's a different risk.
Well, it's different risk, but still, like
Technically, it does.
Remains that Aave is like undercapitalized for surprising situations relative to like their like quote unquote competitors.
Yeah.
I mean,
so
technically it does. If you look at house prices can fall below the value that you price them at, and that is a collateral. A car can get totaled.
but prices dropping is a bit different.
I agree. Point is, they do having worked building financial software for banks and financial institutions in a very past life. The models do assume that some of these assets are going to go to zero, right? It doesn't happen to the degree that it happens in crypto, of course.
Yeah. Yeah. I mean, so I saw some interesting takes on Twitter. A lot of it was kind of along the lines of like, well, Aave has the money to cover it. Which I think from a narrative perspective is actually quite important. Like we were discussing offline, like if Drift had like a jump trading, can tweet within 5 minutes,
Sugar
we're going
daddy,
to cover it kind of thing. Like that helps the narrative, that helps stem the bleeding quite a lot. And Aave kind of has some of that narrative as well. But it does make me think like do these people think that Aave, the company, is gonna just put 200 million of their profits back to the protocol? Like, no. Like, it's one could wish, but like I think that money is gone. Like I think that that sort of perception that there's like just hundreds of millions of capital that's been extracted from the protocol that in any moment is going to be put back in is totally wrong. It's also like there's another one like which is sort of like, well, Stunny, you can just buy up essentially infinite amounts of Aave token, which I also don't think is true at all. Like it's not like there's really no incentive unless you think that like by doing that you are going to get some like guaranteed multiple on your money. There's like no reason to do that. I suspect Jump never put the money back in. The narrative matters, but I don't think that kind of money is being floated like in reality in any situation. Like maybe Justin Sun is actually doing that shit. I don't know, but
and to defend that position, one could say that you took that collateral asset, you moved it to the another place. You as a user took that risk. Like, should you be bailed out from that? Like, with the protocol, it's like I assume the terms of service essentially say no to that situation. So the reason to cover holes is a purely like capitalistic, which is like, if we cover the hole, we dominate the market, and if we don't cover the hole, we don't dominate the market. Like,
that's
problem in this. But the problem in this case is that it poisoned other users essentially, right? Which is your problem and not those users. They didn't add it as a collateral asset and so on.
Yes, yeah. But to extend this analogy, like you lent into these cross pollinating markets, and like it's at your risk essentially.
Yeah, that is the only reason why you would front this money. I mean, if you have 100 million, why would you take them out of your pocket? Well, because you think that by putting in 100 million, you're going to salvage a business that then is going to make you more money than the 100 million. That is the only reason to do it. We could use it as a stage on how fucked is Drift, because even on the situation where Drift had 150 million to put in to plug a hole themselves, there was that calculation that basically it would take them, assuming that trading were to resume at the same level as before, which is unlikely. But assuming you paper over all the trust issues and trading were to resume at the same level, it will take him about 21 years to recover the 21 mil, get the 150 mil.
The multiples on these things just like don't add up, right? Like your fee structure is just not big enough to ever pay back like a massive loss of collateral. Like it's just not, and it can't be. Like that fee structure wouldn't be competitive in the marketplace. But it is like,
this is a very good deal for like the ones who do have capital, because like you can extend that with like, hey, it looks good, like it looks like we're going to make our money back, we'll kind of help you out to roll out the process step by step, if that were to be the case. And if not, we can like, we have no obligation to help out. I think Drift did the deal that was available to them. It was the like right thing to do and the only available play, but that still is like, obviously you're very far off from actually recovering from this situation. But any other choice here, right? Like that's
Yeah, but it's we still have to assume that it's pretty fucked, right? I mean, I don't think they're coming back from this.
I mean, as a counterpoint, Bitfinex came back. They did have probably some tether,
and they're going to issue the
movement.
Bitfinex
Yeah.
token. Well, like Drift token holders are pretty far, they're hundreds of millions away, right, from like in the preferred capital structure. They're like very, very low. So, but like, I guess this is the thing, like in previous markets, Drift actually, I think, would have covered from this, in the sense that in times, if you remember, still a time when tokens went up and like blue chip projects had high valuations and could issue a token like this, and it could cover hundreds of millions. In that day, Drift would have been fine. It's today,
Yeah.
it's fine, right?
Yeah. I mean, yeah, there was a period of time where you could like kind of rely on like a massive speculative bubble in the near future that would just like bail you out.
Yeah, like Drift token had pretty lot not that long ago, and for a pretty while it had like a market value of close to $1 billion. Right? And then it's like, hey, how do we cover a couple hundred mil hole? Well, you issue out a new token that's preferred structure, essentially, yada yada, and life goes on. And like, yeah, your trading volumes. The thing about the Drift trading volumes taking 20 years to pay back. Yes, but not true if because those trading volumes also go significantly higher if your product is successful and kind of there's on-chain activity. So like obviously now the situation looks bad. I don't think there's a way to recover from that, but I do think that had this hack happened in 2021, the right moment in 2023, they actually would have recovered from this.
Yeah, but okay, sure. But also in 2021, I don't think they were competing with Jupiter Perps, which we even discussed today, had already been eating their lunch for quite a bit, right? Like, if basically the only reason why somebody would go back to trading on Drift right now is because it offers a perp that Jupiter doesn't, or any other exchange doesn't, and they need to trade it on Solana for whatever reason, right? Like otherwise, why would you assume that now they have blocked every issue and that this shit is not going to block on your face again?
Yeah, just to close off on that, on the Aave side of things, would you guys agree with the statement that like ultimately this hasn't hit Aave that much, like less than you'd expect?
It's a good question. My first intuition was they're fine. My second intuition is the second group of people, which is Euler, Morpho, Maple, Camino. They are a little bit more open. Like it is.
They have a chance, yeah.
Yeah, so Aave is fine in terms of Aave will continue to operate and be dominant in the market, but now the door is a lot more open for the second tier here.
So they lost. So like the way to I think look at it is they lost about 10 billion in TVL, which is like a huge amount, of course. On the flip side, their token is trading pretty much the same.
I haven't checked it.
Like it's tracking, like it's like the TVL chart does not look the same as the token chart.
Yep.
And so like my read on this is that like if people were like genuinely panicking about Aave as a protocol, like as a investable thing, those charts would look the same. The TVL was taken out for risk management purposes, but then like I think probably it just comes back once everyone's like comfortable again.
Yeah, I think people are also underestimating, like, oh, you just are comfortable again in this life. And like, yeah, I don't think, like, I think they're fine and like kind of get to continue on from here. This does go to the previous podcast where we were talking about price stops going down on bad signals kind of thing, which is like, hey, like, this is like awful stuff. Like, even the drift price didn't go down to like what you would expect it would. Like, after the hack for a while, they didn't even move, you know, like, it was
Yeah.
like insane, insane stuff. So like that is the kind of cyclicality guy in me being like, hey, yeah, this is the awful shit that happens.
I
but
mean,
like, yeah,
I don't think there's that much more that hackers can extract.
Okay, so
Hopefully. But if you look
So-
at the list of hacks, like I don't know that we've ever seen a spree like this. Like this is eluding.
and
Yeah.
and it should be said that like it used to be the case that we had the like smart contract hacks all the time, and it was the kind of classic re-entrancy stuff all over again, yada yada. These ones are different and a different class, and the barrier to doing these honestly
Although
should be higher. Like, it's
Reentrancy doesn't work anymore because they
Yeah,
can
yeah.
bot
Right.
get it.
yeah, re-entrancy doesn't work. Yeah, so that's my point, right? So like that we it surely someone can do like kind of insane Ocean's 11 style, you know, move here, but the barrier to getting these key hacks has to go up here. Like, come on, guys, like we can do better than
Maybe-
this. We'll do
Maybe
better.
more than signers I can count on one hand might be the way.
Yeah. And like all these like risk management things, which one could talk in detail about what exactly they are for lending markets and stuff, but it doesn't really matter in the sense that like there is low hanging fruit to be picked here. And that low hanging fruit honestly gets you like a lot further along this. Of like the odds of you getting hacked just like go down so much if you just like go from 1 of 1 to 5 of 7. You know, like it's just, but it doesn't mean that those don't happen. Like buy big, go, right? So, but like, you know, it there is still like low hanging fruit here to be had, and there will be hacks in the future, but hopefully they're like, you know, more of that kind of, you know, movie level Ocean's 11 style. You know? Yeah. Like you really have to like go underneath the lasers and do like all this stuff to like really get that. So,
Hey, you know, Mika, one thing on the drift price, you said that they hadn't gotten hit as badly. So for what it's worth, it is still about half the price that it was before. The
No.
hack.
For a while, for a
For a while.
it is like illogical, right? Like that is not. It should go down more. It like I don't understand like how.
Okay, first of all, I'd say give it time. I think people are still processing. I suspect that a lot of people haven't really processed exactly what happened with this bailout plan thing, and that this really isn't solving anything. I don't think people have fully assimilated that this is fucking dead. Then second, I suspect, I have no inside information on this, but I was tracking the drift price after they launched the token for a bit there, not just the price, the trading pattern. And it was very clear that someone, probably one of the investors with like a lot of tokens, was selling it was like constant sell pressure every time it got to like 70 or 75 cents kind of thing. So it wouldn't surprise me if a lot of like large holders got out relatively, but relatively early. I mean, before 2025, kind of thing.
Yeah, I think that's possible.
So what I'm saying is that I don't think there were like large holders getting freaked out about this when it happened, because they probably had already cashed out.
So, what do you think all this stuff, like, how does this affect DeFi in general? Like, I think I think actually the biggest loser out of this is DeFi in general, not even any particular protocol. Like it does,
It's
like I don't see any way that like users of these things don't just like have in the back of their mind the whole time when they're using this stuff, like, oh fuck, like everything's been hacked. When is this going to be the thing that I'm
That's
using?
the bear
well,
case,
so
which is just purely, hey, 4% capital, like it's just risk reward just goes out the or risk reward. No one wants to do that, and
You mean 4% yield or what?
yeah, 4% yield. Like, and DeFi has to offer 7-8% yields to do that, which means that like there's a lot less demand for to create those rates essentially, right? So, and
I mean,
that's like an order of magnitude drop in DeFi TVL, like,
arguably, why
for bear case, and that's
if what
almost
you,
DeFi.
if what you want is that yield, arguably, if and you want to do and you're willing to take risks, right? Because I am decidedly not advocating anybody goes into this, but strategy right now is paying like 10, 11%, and yeah, and you're not going to get DeFi hacked. Then you can mostly trade it freely on the market.
Oh,
And
but
seriously, strategy is like the best version of it is saying, hey, it's like 1/3 levered instrument that's paying out this. Like it's not. It's
Yeah.
you can make an argument it's not as bad of an
people are-
instrument.
People are looping STRC on chain, so like
Yeah.
you have the same dynamics.
No, my perspective on this is basically okay. So one caveat to this is that this assumes a rational, informed player, and if there's something that the history of DeFi has shown us is that the vast majority of people using it are not acting rationally or informed, although that may have changed. But it's basically what I said the last time that we recorded, that I would be right now very concerned about having money just sitting in a fire and forget smart contract. Because if I'm not paying attention, there's a big chance that the people running the program aren't paying attention like Drift wasn't and like Aave wasn't. So if anybody has been looking particularly at the sophistication of these attacks, this wasn't, again, just some stupid smart contract bug getting exploited. Like the Drift team was suckered in by these people sending, I imagine, ringers to events and stuff. Like the way that the sophistication of these attacks is increasing, I would be very hesitant to get back into a fire and forget thing until there has been very clearly, let's say, a stage of in-depth auditing and disclosure of vulnerabilities, like to the level of, this is unrelated to crypto per se, but to the level of what the link that I sent you guys that Mozilla reported they found with Mythos, that was something like 247 vulnerabilities fixed in a single release, up from 20 that Opus 4.6 had detected before. Until I start seeing like this level of disclosure of issues in crypto, I would be very hesitant to go crazy on this with anything that you're not willing to set on fire, basically.
And there needs to be a standard very clearly of, hey, this is how everyone operates. And
so can I give like, I agree we need to get way better at this. And I think like, I think we certainly can. Like there's this centralized exchanges went through the same progression, right? Like in the beginning, it was just rando teams doing this, and then like they needed to get more and more sophisticated, and some of them got hacked, etc. So I think it's definitely possible. I do want to mention that like when people start saying things like there needs to be a standard of security, that very easily leads to regulation, and regulation creates barriers to entry, and that has downsides as well. Like it does have legitimate sort of consumer protection positives, but it does mean we cause, like, if you already like thinking about it now, right, there's this sort of informal standard that you get a bunch of security audits, the auditing firms charge like 100K each, like for basically or auditing boilerplate, and then they never find the bugs anyway. And that's already like a certain barrier to entry, but once you sort of increase that, you you have the counterpoint that it becomes much harder to get new products to market, and so then you have like I mean, it's what happens in all mature industries to an extent, but you do have this sort of like solidifying of the incumbents, and maybe that's what needs to happen. But I think like it, given that it hasn't fully happened yet, it's worth sort of trying to find some like good balance that does allow new things to occur.
I advocate for what I meant by standard is like market-based solution. I just meant like, hey, everyone knows that when you run like one of the LZ instances, you do 5 out of 8 or whatever. You know, like that's already so much better than this, and makes the attack like, doesn't mean there's no attacks, but it makes it 10 times less likely essentially already.
Yeah, I mean, it just, so the as far as I understand with layer 0, it's the issuer that sets the parameters for the bridge, and so like this really needs to come from the issuers. They just need to recognize that, like, I mean, honestly, layer 0 could also be like, guys, everyone needs to have more than one.
Yeah. They could have been, that's definitely true. Like they should have been like, hey guys.
Yeah, look, I wasn't the one that brought up the standard thing. I think it was Mika. I do agree that this is not a regulation thing, and even if it were an issue of regulation, even if I thought regulation was the solution, regulation is going to trail attacks significantly. So by the time regulation comes out, it's going to be fucking useless. But what we do need is
and worse is that like you'll have regulation designed to protect against this, but then it'll essentially have this cascading effect on all kinds of applications that suddenly will not be viable because they're like,
and it will cause something else. Like it'll cause something horrible.
No, but basically the way that I would phrase it is that what we need these teams to realize is that they're playing with the hundreds of millions of dollars of other people's money, and they need to start acting like fucking professionals. And part of acting like a fucking professional is looking at what's going on in your code from multiple angles and disclosing the issues that you found once you fix them, so that people know they can trust you in the future. Right? It is a base standard of behavior. It's not a standard of regulation.
But this Aave thing wasn't really a code thing.
No. I'm mentioning the drift. I'm still going on the drift issue.
I'll just restate that. So I think everyone should be more cognizant of the fact that they're playing with hundreds of millions of Justin Sun's money, and that's why they should make sure that they have more signers than one.
That might be even a nice note to close on the Justin Sun advocacy episode.
Yeah. All right. On that note, we'll see you next time. Stay safe. Check how many layer 0 signers there are on assets that you're holding. Have a good week, everyone. Bye-bye.
Ta-ta.